Good afternoon. My name is Eugenia Yudanian, and I'm chair of the Professional Advisor Network of the Jewish Community Foundation. Thank you for joining today's seminar, which is called Flexibility Wins, the Case for Donor-Advised Funds. This is the first of a two-part series called Let's Talk Philanthropy. Part 2 is on November 19th, and I strongly encourage you to join us then. It is important for us as advisors to discuss charity with our clients. Donor-advised funds provide a flexible and therefore very popular vehicle for charitable donations. And the Jewish Community Foundation has a very robust donor-advised fund program that makes this vehicle very user-friendly. Our speakers today are well-known experts in their respective professions who will provide you with an in-depth analysis of the donor-advised funds. So by way of introduction, Anita Siegel is a founding member of the law firm of Siegel and Bergman and is a trustee of the Jewish Community Foundation. Mark Lewis is managing director with a private bank at JP Morgan. Michael Schechner is the chief executive officer of Schechner Lifson Corporation and is an insurance professional. Larry Choder is a partner in the law firm services group of Wyss & Company, which itself, though, is an accounting firm. Matthew Abrams is of counsel at the law firm Sills, Thomas & Gross and is a member of its tax, trust, and estates practice group. As an administrative matter, if you have any questions in the course of this presentation, please use the Q&A or the chat feature to post them, and we'll address them at the end of the presentation. Thank you, and now here's Anita.
Good afternoon. Today we're going to try to take your mind off the election for just an hour and talk about a topic near and dear to my heart, namely charitable planning. The question we're asking today is, why is it important for advisors to speak with clients about charity when discussing their estate plan in general and their financial matters? Clients generally come to us focused on planning for their family and may not have thought about charity as part of their estate plan, even though they regularly give to charity every year and did not give any thought to including charity in their estate plan. Sometimes they do not give any thought to including charity in their estate plan unless and until it is specifically mentioned to them. Today, with the current very high federal estate tax exemption of $11.58 million per person and no New Jersey estate tax at all, clients may not think tax planning is necessary at all. But as a result of the pandemic and its impact on the economy and the fiscal health of the federal and state government, we may be about to see a significant change in both the federal and New Jersey estate tax in varying degrees, depending on the results of the election, whatever that may be. In addition, we should not ignore the income tax aspect of charitable planning, since for many of our clients, this may be the only tax savings that they may obtain. And we should not ignore the purely philanthropic desires of our clients and the advantages the client has pursuing charitable interests during their lifetime and after their death. So these are all things that we need to think about when we're talking to our clients about charity. It's tax planning, but it's more than tax planning, and there's all the different taxes to consider. In the current environment of the pandemic, civil unrest in America, and other issues, there's even more than the usual substantial fundraising going on. We're bombarded with it all the time, on TV, on our social media, everywhere you turn. It's a good time to ask clients if there are any particular issues that they are particularly concerned about and supporting through donations or through actions, and those issues that they want to support in the future through some charitable planning. Asking clients about issues that concern them and their family may be a great way to learn about them and their children. It can also be a good opener for discussion about philanthropy and getting the next generation involved in their charitable endeavors. We can assist our clients in pursuing their and their family's charitable interests during life and through their estates. So the question is, what are some of the charitable vehicles for our clients to consider in doing their planning? So let's look at some brief description of a few of the charitable vehicles we might discuss in their planning. First would be outright bequests to specific charities that they might name by a specific dollar amount, a specific asset to a charity, such as 100 shares of AT&T stock, a percent of the residue of their estate, the balance of their estate. That's a simple way to do it. We could also designate a charity as the beneficiary of all or a portion of a life insurance policy or an individual retirement account or another qualified plan, such as a Section 401k plan. We could name a charity as a 20% beneficiary of a life insurance policy, named to go to a particular charity on the death of the insured, or a percent of an IRA to be payable to a charity upon the death of the IRA owner. Those are perfectly good. Now, I'm going to talk about some more of these charitable vehicles, but each of you received, hopefully in advance, I believe yesterday, a very detailed multi-page outline of charitable planning, which gives you income, gift, and estate tax consequences to various charitable vehicles and detailed descriptions of these charitable vehicles. I commend you to look at that if you want the real detailed descriptions of the things I'm going over, because I'm only given just a few minutes to talk about these very complex charitable vehicles. So the next one is called a charitable lead trust. A charitable lead trust is an irrevocable trust, very important word, that we set up for the benefit of our family and charities. What this trust, and I'll talk about a CLAT or a charitable lead annuity trust. It's an irrevocable trust I set up to pay an annuity. An annuity is a specific dollar amount started as a specific percent of the initial value of the trust, and it can be any percent. In my example here, I say 4% of the initial value of the assets contributed to the trust to be paid out to one or more charities for a period of years. Example is 20 years. And at the end of that 20 years, whatever is left in the trust will be paid over to or for the benefit of specific people, in my example, to the donor's daughter. That's a way to provide for charity. That gives charity a 20-year payout equal to that 4% of the initial value, a fixed dollar amount over those years. And the donor is going to get certain benefits from that. That charitable lead trust is a very useful vehicle. It gives a certain amount to the charity over that period of years and a delayed distribution to the child. Maybe I set that up for the child because the child's only 5 years old at the time, and I don't want the child to get that money till they're 25. So there are lots of good uses for a charitable lead trust. That's one possibility. Another possibility, and which is my very favorite, is the charitable remainder trust. This is a charitable remainder trust, and that again is an irrevocable trust. These are important words. And this can be done during the donor's life or upon the donor's death, where it's the flip side of the charitable lead trust, where the charity is the one getting the remainder interest, hence charitable remainder trust. The donor can retain for him or herself or for somebody else a right to receive either an annuity or a unit trust interest, a fixed percent of the value of the trust each year for the lifetime of the donor or the other individual, or for a fixed period of years, no more than 20. And at the end of that term, at the end of the life of the donor, the leftovers go to the charity. So the individual has the upfront interest in the trust, and the charity gets the remainder interest. This trust gives the individual the upfront interest, either the fixed dollar amount annuity or the percent distribution, the unit trust distribution for the lifetime, and then the remainder goes to charity. The charitable remainder trust has a lot of benefits, giving the donor an income tax deduction when it gets set up, gives the donor an estate tax deduction when the donor dies and the remainder goes to charity. And one of the best benefits of the charitable remainder trust is that while the trust is in existence, it doesn't pay any income tax. So there are lots of benefits here. There's an income tax benefit immediately. There's an income tax benefit while the trust is in existence, an estate tax benefit down the road, and the charitable remainder trust has lots of great benefits. Charitable remainder trust can also be set up for the benefit of somebody other than the donor. And then we have a gift. Maybe that gift is to a child. Maybe I set it up for myself and my spouse. So I get the unit trust interest for my life, and then on my death, it continues for my spouse. The charitable remainder unit trust has a lot of wonderful benefits and something to be considered. The next one is, in the charitable remainder unit trust, the individual getting the benefits gets exactly that benefit, gets exactly the annuity, or gets exactly the unit trust. And sometimes if I'm setting it up for my spouse, I want my spouse to get a little more flexibility. So maybe I set up a regular marital trust for my spouse, where my spouse can get all the income on a regular basis, not a fixed annuity or unit trust, but all the income, and maybe can even get principal if my spouse needs it. But when my spouse dies, the balance goes to charity. That's another good use of charity. I don't get as many of the income tax benefits, but I still get the estate tax benefit of getting, when my spouse dies, I get a marital deduction, and when it all goes off to charity, the charitable deduction is available. And so there are lots of good ways to get our charity some benefits here. And then another good use of charity is the donor advised fund. And the donor advised fund can be set up here at the Jewish Community Foundation. The donor advised fund is a fund that we're going to talk a lot more detail about later, but it's a fund that is set up at a public charity. The public charity has to be the sponsor of this fund. The donor sets it up with a fund of money, and over the course of years, advises the sponsor of the fund to distribute certain dollar amounts each year to various grantee organizations, public charities that you want to get the money at various times. And this makes a nice way to teach charitable planning for the family. And I can add to that fund as often as I want, including I set it up during my lifetime, and I can add to the donor advised fund upon my death under my will by a specific bequest of dollars or other assets. And so I can do all of that as well. So these are some of the different vehicles, but we're going to be focusing on the donor advised fund. And now we have 4 advisors to discuss with us how they have discussed and used donor advised funds with their clients. Our first is Mark Lewis, Managing Director at JP Morgan Private Bank.
Thanks, Anita. As Jenny mentioned, I'm a managing director with the private bank at JP Morgan, and this certainly is a timely topic as we head to year end, so great to participate here. Our client base within the private bank are affluent families, and as such, certainly the donor advised fund is often used as a charitable giving vehicle by many of our clients, and certainly the flexibility, the user friendliness, and the tax benefits are the primary drivers. But it can also be useful when not everyone sees eye to eye on their charitable intentions. And just as an example, we have a client who's the chairman and CEO of a major public company in New Jersey. He's married with 2 children in their 20s. He's reaching the twilight of his career, but not retiring tomorrow, still very active and busy leading a major company. And his charitable goals are really evolving, and certainly COVID has brought this to the forefront, but there's really no clear philanthropic plan in place as of now, and no real family involvement yet, but he definitely wants to develop a plan. In terms of his kids, which is important in this instance, they're both very independent, successful in their own right. The kids see the world very differently, though. Their political views are very distinct, and it's certainly been, no doubt, pronounced this week. And our client and his wife know their kids will never see eye to eye on certain aspects of the world. And they do not want to put them in a position of conflict in the future. This happens to be a high income year for our client, and he wants to make a significant charitable contribution. He also wanted to make use of some appreciated securities if possible as well. And this raised a number of issues for the client that we talked to him about. How do you help a busy executive move forward on a charitable plan that does not have a great amount of time to focus? How do you deal with appreciated securities if certain local charities will not accept those securities? How do you find the right solution for a client who's cost sensitive across the board? And how do you help a client who lacks clarity on charitable goals or designations, but wants to develop this, but wants to reduce taxes this year? And what happens if both he and his wife pass? What's the legacy, the succession plan? How do you hand over philanthropic responsibilities to children who do not agree on everything? So the donor advised fund, or as we call it in short, the DAF, made sense for a number of reasons. And I know Anita's going to get into more detail on the mechanics of the DAF, but a few highlights that appealed to our client. One centered around the low administrative burden with the DAF. That was very appealing to him. It's very user friendly. You simply fill out an application, you set up the DAF. It's a quick setup. You provide it with online access and management. And this works very well for someone who's extremely busy. And I know we all advise clients that have that type of challenge. Also, the DAF accepts appreciated securities. Our client has certain local charities he wants to give to, but they can't accept appreciated securities. And that's where he wanted to draw from in terms of making donations this year. Also, it's a fairly lower cost type of vehicle when you compare it to something like a private foundation, as an example. There's no annual tax reporting like a private foundation, no legal setup fees or accounting fees. And once again, less demand on our client's time. You get the dual tax benefit. You avoid capital gains. You can take the charitable deduction this year, which he has done. And still leaving him time to solidify his charitable plans. He can decide where he designates his dollars down the line. He also could front load his donation this year and roll forward unused deductions for 5 years. So, and you know, keep in mind too, it's actually a greater deduction than a private foundation in terms of the threshold against adjusted gross income. I guess, you know, also keep in mind that, you know, while our client solidifies and gradually implements a charitable plan, obviously it's appealing to him. The assets will continue to grow tax-free. He's going to retain advisory oversight over investments, which is important to him. And can be anonymity as well, as there's no 990 reporting. But one thing I thought was unique with our client was the DAF addressed his concern about his kids not seeing eye to eye in the future. We had a lot of discussion on this topic, and their kids' differences will never change in their view. So from a legacy planning standpoint, our client simply set up the DAF. So upon his death and his wife's passing, the DAF will actually split into 2 DAFs, and it'll allow their son and daughter independence in their giving to avoid conflicts. This was a very easy solution to a potentially complicated situation down the line. And I think that was also very appealing to our client. So I believe the DAF, it's really very effective. It's flexible, it's user-friendly as a charitable vehicle. And as such, our client opened a DAF, contributed appreciated securities, and they're very happy that they did so. So, and now I'm going to hand it over to Michael Schechner, who's going to tell us about a situation where he used a life insurance policy combined with a DAF to help his client.
Thank you, Mark. So I want to share with everyone the story of a client of mine. This is a couple. At the time, they were in their early 50s. They were wealthy. I wouldn't say they were super wealthy. Both husband and wife were very charitably involved. The husband was a little more visible in his charitable activity. He was a past president of his synagogue. He served on several boards in the community. The wife was very involved as well, but she was more, if you will, hands-on, not as much in leadership positions. She was the one that would go to the nursing home to play bingo. She would go to the group homes and visit with the children. They gave away $30,000 or $40,000 every year to a variety of charities, Jewish Community Federation being among them, their synagogue and some other places that were important to them. What they also did that they didn't tell anybody about, the wife would make charitable gifts to a whole variety of charities, that mostly ones that her friends were involved with. And she was of the position that if this charity did good work and it was important enough to one of her friends for them to give their time and effort and ask her for a gift, that she would want to support them. And these gifts tended to be $100, $200, maybe as high as $500, but she was giving away about $7,500 a year, different charities each year. These donations were very, very important to her, but they were never recognized, never seen, as opposed to the husband's activity, which was known in the community. And she felt a little bad about that. Not that she was looking for recognition, but she wanted to make these more her thing and a way of memorializing, if you will, or maintaining the good that she was doing. She confided she was actually a little embarrassed that she felt that way, but you feel what you feel, and she acknowledged it. So we came to a plan that really suited everybody. They bought a life insurance policy on her, made a donor-advised fund at the Jewish Community Foundation the beneficiary, the owner and beneficiary of the policy. We named the fund I'll say Jane Doe, the Jane Doe Do Good Fund. And here's how it worked. Every year they would make a gift to the foundation of $10,000. That was fully deductible to them. The foundation used that money to pay for a life insurance policy on her life, and the premiums were designed to be paid for 12 years and then stop. At her death, the donor advised fund would receive a minimum of $500,000. $100,000 of that went to endow the gift that she made annually to the Jewish Federation, her Lion of Judah gift. That left $400,000 in the fund that her 3 children would be responsible for giving away. They were named as, in the world of donor advised funds, what are called the recommenders, and they would be charged with giving away this money in large amounts, small amounts, whatever they wanted to do. The wife then wrote what's known as an ethical will. This was essentially a letter to her children, which said, this is what I do, this is why I do it, these are the causes, not specific charities, but the type of causes that were most important to me, and I'd like you to give away this money in my name. It's helped keep the children close. Mark talked about when children don't get along. These were children that did get along. She told them about it in addition to the ethical will, and they were all very excited for this. So the result of all of this was she got a little bit of immortality that she was looking for. The charities got some nice money, or rather they will get some money, hopefully not for a number of years into the future. It was very, very easy to set up the whole structure. And actually, at the end of the day, the husband gave this gift to his wife for their 25th wedding anniversary. And she has told me over and over again that it's the best present she ever got. So that's my story. I'm now going to turn it over to Larry Choder from WIS, who has a story of his own, I believe. Larry?
Thank you, Michael. As a public accountant, I have very much insight into what's going on with my clients. So I know what the family dynamics are. I know what their finances are like, and I know what their history of charitable giving is. So that puts me in a unique position to ask questions about what their intentions are in the future. I also know about what's happening in the present. So my example is one that's very current. I have a client that owns a very successful medical supply company. As a result of the pandemic, they have access to suppliers who provide PPE equipment, and they've had 100% increase in revenue during the year and a lot of profitability. And the discussion centered on how do we do something meaningful? And they have the ability to donate a significant amount of money, but they want it to be easy. So we talked about, well, what are the options? Well, there could be a direct donation, but they're not so sure about exactly who they want to give it to and when and how much to each charity. So they need time to think about that. So the conversation centered on, okay, you can do a private foundation or you can do a DAF. But that was a quick conversation. A donor advised fund, very easy to set up, can be done in a day or two. There's no setup costs. A private foundation takes a significant amount of time to set up, and it's expensive, both to set up and then on an ongoing basis with reporting, potential excise taxes, requirements to make annual contributions to the charity, whereas a donor advised fund, you don't necessarily have to make a donation in a given year. You have time to think about what you want to do, who you want to give it to. So that part of the conversation was easy. The decision to set up a donor advised fund made perfect sense. The next thing we discussed was, well, what happens if I pass away? Well, I think this was mentioned already. What can happen is you can have it written into the agreement that the fund will split down the road. So if there are multiple siblings and the siblings, whether they get along or not, maybe each one can have their donor advised fund down the road, and then they can make decisions on who they want to give charity to. So this is really a legacy gift. As far as taxes go, no conversation with an accountant ever avoids that topic. So, and people are concerned with that. In this example, it was a very significant contribution. The individuals are in the highest tax bracket. So bunching donations was not a significant concern of those. And what I mean by bunching donations is, let's take an example of somebody who earns $300,000 a year, and they are limited in their real estate tax and state tax deduction to $10,000. Maybe they have a mortgage, maybe they don't, but the standard deduction is approximately $25,000. So in that case, the first $15,000 that is given to a charity, there's no tax benefit to that taxpayer who's earning $300,000 a year. So what bunching means is a consideration. Instead of giving $15,000 a year for 3 years and getting no tax benefit, bunch it and put $45,000 into the donor advised fund at once. Well, what kind of difference does that make? It's pretty significant. A $300,000 adjusted gross income taxpayer will save 24% of the charitable contribution over what they need to get to $26,000. So you can, I was going to put up a slide, but I figured that's what everybody would expect from an accountant, so I'm not going to do that. You can do the math pretty easily, but 24% on, that extra $15,000 a year certainly adds up. And in a taxpayer who's in a $700,000 adjusted gross income bracket, that's the highest bracket, it's 37%. So you can do the math on a $45,000 contribution. The first 15 would go against the standard deduction. That extra $30,000 times 37% is a significant amount of money. That's right in your pocket. So the donor advised fund is an easy sell, really easy to set up. As I said, really easy to maintain. Other concerns that I've heard from clients that I've done this with are, well, are the investment fees going to eat up a lot of the asset? And I think something that's important to know is your client needs to know that if they put that money, once they transfer that money into the DAF, it's no longer theirs. So they get their full charitable contribution, no matter what happens in the future, whether the investments go up or down. That doesn't impact them. It does impact the charity, obviously, because the charity will get more or less depending on how the results are. But it has no further tax impact on the donor. Once they make that contribution in the first year, they don't have to worry about it. So that is also something that they're concerned with. And note the no strings. I have clients that have sophisticated tax planning. Anita knows about this, trusts. And the one common complaint that I get is all of the extra accounting fees for preparing tax returns, all of the discipline required to know what trust it's in and what they can do with the money, how they can distribute it. The donor advised fund is just simply a piece of cake. All they have to do is notify if it's with the Jewish Community Foundation, just let them know who they want to donate the money to. If it's a 501c3 charity, pretty much without question, they'll be able to make that donation. And finally, from a tax perspective, clients are concerned with, can they donate appreciated securities, which they can, and can they donate their IRA or directly from a retirement plan? That they can't do during their lifetime, but they can make a designated beneficiary as the charity, and then upon their death, that money will go into the DAF, and then the DAF can take care of it. So that's pretty much my story. Clients are very, very pleased with the ease of administration and the ease of setup. And now I'd like to turn it over to Matthew Abrams.
Thanks, Larry. So my story, my example has a lot of the same hallmarks as the example shared by Mark and Michael and Larry. My example is one where there's a large family whose patriarch created a very significant manufacturing business from the ground up. And the family had several children, some of whom were involved in the business, some of whom just enjoyed the benefits. And by the time I became involved with this family, my primary contact was one of the family's sons, heavily involved in the business, and in fact, the president of the business. He and his wife, we'll call them John and Cindy, were very active in charity on both a domestic and an international basis. Unfortunately, Cindy passed away, and John, while he wanted to remain active in the business, wanted to continue his charitable work, he was trying to figure out what to do, given the fact that he no longer had a spouse and had no children to carry on a legacy on a sort of a typical basis, like some of the examples you've heard already. John didn't want to give away assets any more than necessary, because He wasn't sure what his long-term care costs would be. He didn't want to keep it all to himself because that wasn't in his nature, and it wasn't what he and his wife had contemplated in the absence of children as a sort of primary legacy to the world. He wanted charitable deductions against his income, as Larry just illustrated. He wanted control over where the money would go, whether or not he gave it away to a charity or a fund. He wanted to then be able to exercise some further oversight, like I'm sure many of your clients do. And most of all, he wanted simplicity. Rather than give the funds all to charity during his lifetime or only at his death, and rather than giving the funds to his siblings to decide what to do with, he decided to, with my counsel and with input from his own contacts at the foundation and his own federation, he wanted to create a donor advised fund. He essentially was old school enough that he did not want to give to any charities general uses and purposes. And so this became the ideal answer to his issue. With this donor advised fund, he named himself, of course, as the initial donor advisor. He designated particular successor donor advisors among his nieces and his nephews. And he worked with the organization. We together worked with the organization to create a mechanism for adding to that group of advisors so that there would always be members more and more of the family, particularly descendants of his father from whom all of this had been created. That group, the fund became particularly helpful when there was a significant liquidity event, when there was an acquisition of this family business by a much larger conglomerate. He needed a big deduction. The donor advised fund provided a mechanism for that. And in his will, he left a bequest of approximately 30% of his residuary estate to this donor advised fund. The group of nieces and nephews, and now another generation below that, have used the fund and its very significant balance to benefit the sponsoring organization, of course. Even beyond the administrative expenses, they make a large gift to the organization's annual campaign out of these funds. And also to make essentially seed money type grants to charities, whether they're small or large, but ones with particular programs that need the kind of data and history that will allow those programs to expand significantly from much, much larger foundations and charities. The group benefits from the charitable experience itself without having to necessarily commit their own funds, though the charity, of course, has easy inroads to all of these donor advisors and members of the family because of the fund, because they have an existing connection. It's easier for the professionals on the charity staff to be able to reach out and say, well, would you be willing to make a direct gift as well? And the group itself also benefits as a family from being in touch in a way that they might not be, given the fact that some of the members of this fund are second cousins once removed, third cousins from each other. They might never be in touch, may never see each other, except that this fund and the discussions and the meetings that are involved in the grant making provide that kind of opportunity to connect and to do good while maintaining a family, a very large family. All around a win-win. The client in adopting the strategy liked it because it achieved everything that he wanted it to achieve. And the family continues to be appreciative of the opportunities that this donor advised fund provides on a number of levels. So with that, I'm going to turn it back over to Anita for a more in-depth discussion on donor advised funds.
Thank you, gentlemen. So now we're going to dig down a little deeper into what is this thing called a donor advised fund? Well, it was first created back in the 1930s by a few community foundations and Jewish federations. But we didn't get statutory and regulatory recognition until the Tax Reform Act of 1969 that officially created donor advised funds, or DAFs. They started to really grow in usage in the 1990s, but they exploded in the last couple of years, and especially the last 2 years, because of the changes in the tax law, as it was explained by Mark and the others. So what is this? This is a fund that is sponsored by a public charity. It has to be sponsored by a public charity. And the individual or group sets up a fund at the public charity. The donor advisors recommend grants to public charities from the fund from time to time. Notice I use the word recommend. It's not that the sponsor has to give it to them. On the other hand, if the sponsor doesn't make it to the charity that's recommended, makes the grant to the charity recommended by the donor, well, then the sponsor is probably not going to get too many donors to use them. But it's the sponsor's obligation to make sure that the donee organization is a qualified charity to receive it. And that's really the only time they're going to refuse to take that recommendation. So we say that the donor recommends it, but it's usually taken. So in setting up the DAF, the donor can specify a lot of things. First of all, the donor can name the fund account. They may name it by their own name. If they want the donations to go out, the grants to go out in their name, then they can name their fund after themselves, or they can call it their family name. I could name it the Siegel Family Fund, or whatever I want to name it. I can designate who the advisors will be for my fund. I could add my children, my spouse, my friends. I can name whoever I want to be the donor advisors with me. I could make it a committee, and it can be family or friends. It can be whoever I want. I can designate who the successor advisors will be. If I'm not around anymore, who will take over as my advisors. I get to recommend the grants by the amount and the donee charity. I can say, give $100 to Jewish Federation. I can say, give $500 to my alma mater. And it's subject to the sponsor's confirmation that the donee organization is a qualified public charity, but then they distribute that money out. I can support multiple charities at one time. I don't have to just give it to one charity. So as long as they're the qualified charities, I can do that. I can specify the use of the funds to be used by the charity. I can place restrictions on the use of the funds. So when I give it to my alma mater, I can say it's for scholarships. I can add to the fund anytime. And each time I add to the fund, I'm going to get another income tax deduction. And I can add very simply with cash, securities, etc. So that's how it works on a simple basis. When I'm the donor, I'm making a donation to a public charity because the sponsor of my DAF is a public charity. Each addition to the DAF is an irrevocable commitment to the assets of the charity. I can't take it back. It's there. I may not have it distributed out of my DAF this year. It may not go out till next year or a few years down the road, but it's an irrevocable commitment to the charity. So the donor is entitled to the income tax deduction each time I add to the DAF in the year I add to the DAF, not in the year the DAF distributes it out to the donee charity. And since the sponsor is a public charity by definition, the amount of the income tax deduction is determined under the public charity rules for income tax deductions at 60%. And that's really good. Now, because it's a public charity, I also get a gift tax deduction. If I'm worried about gift tax, and I might be because I'm making a gift, it's good to know it's a public charity, and therefore I get a gift tax deduction also. Now, we've heard by each of our speakers why they recommended the DAF instead of a private foundation. In many cases, this is really important. So let's go through why is a DAF different from a private foundation? Because what some people call a DAF is a poor person's private foundation, but I think we're finding that a lot of our very wealthy clients are preferring the DAF anyway. So the private foundation is a separate legal entity. Because it's a separate legal entity, it has to be established as a separate legal entity, and establishing that legal entity is expensive. It has to apply for its own tax-exempt status. That in and of itself is an expensive thing to do. It has strict tax and other legal requirements, which are expensive to maintain. It has its own tax filings, annual tax filings, not just the initial tax filing of getting its tax exempt status. The public has access to its tax and other filings because they have to be made public. It has strict tax rules and excise taxes that apply for failure to comply with those tax rules. There are excise taxes on income. It's not totally income tax free. There are minimum amounts that must be distributed each year with an excise tax that applies if the minimum is not distributed. And that's 5% of the value of the assets of the private foundation each year. There's the people of the private foundation have total control over investments, but subject to strict rules and excise taxes. There are certain investments they cannot make in the private foundation. And there are certain limitations on investments that deal with the relationship with the foundation board of directors and insiders. There are income tax deduction limitations which are lower than those for public charity donations. The income tax deduction for a private foundation is 30% with respect to cash donations and 20% for appreciated property. And the annual administrative costs are very expensive in running a private foundation. However, when we turn to the donor advised fund, we find it is much less expensive. The donor advised fund is not a separate entity. It is a fund that is part of a sponsor public charity. So the setup costs are none. We just apply to open an account at the sponsor public charity. There are no separate tax or other filings that are required. There's no public access to the tax or other filings of my DAF, right? Other people can get access to the filings of the sponsor, but not my DAF. There's no income tax on the income of my DAF, and there are no excise taxes. There is income tax-free growth in my DAF. There's no minimum required distribution amount each year. If I don't want to distribute anything this year, I don't have to. So those rules do not apply, and there's no penalty for not distributing. The contributions to the DAF can be made in cash, equities, non-publicly traded assets, and then the distribution to the donee grantees or organizations is made in cash over time with no tax paid on any gain that was incurred in the DAF when the assets I contributed were sold. The sponsor makes the distributions to the donee charities upon the recommendation of the donor or the donor advisors. The sponsor manages the investments and files all tax and other reports at its cost, paid by fees it charges to all the funds in the DAFs for all the services it provides. All those fees are spread among all the DAFs and are usually reasonable per DAF. Since the sponsor is a public charity, the amount of the income tax deduction is determined under public charity rules, as we said, 60% charity for cash donations. It is simplified reporting for the donor because all you're reporting, the donor is reporting, is the gift made to the DAF. When I as a donor make a gift to the DAF, I get my income tax deduction for that gift. And if I make multiple gifts during the year, then I add them all up, and that's what I take on my income tax return for that year. And it's the DAF that makes the distributions to the charities during the year. If I focus now just for a moment on our Jewish Community Foundation DAF, why is it special for our Jewish clients? Well, it's a great DAF for the Jewish client who wants to give Jewishly, because our JCF staff is very experienced with respect to Jewish charities here in New Jersey as well as internationally. Our JCF staff provides personalized service to the donors and can provide specific recommendations for donee charities that match the donor's charitable desires and align like-minded funders to leverage their gifts. The fees charged by JCF DAFs are no more than commercially sponsored DAFs, but our JCF fees go back into the Jewish community because JCF sponsors all kinds of wonderful programs and provides services to our community. So it's nice to know that if we're going to pay fees to a sponsor of our DAF, that those fees are going back into the Jewish community. And a JCF DAF can give to charities other than, you can use your JCF DAF to give to charities other than just Jewish charities as well. You can give to the alma mater, you can give to the hospital, or other kinds of charities as well through your JCF DAF. But these are special things that you can do with your JCF DAF. So how is the DAF an easy thing to use for our donors? Well, most sponsors of the DAFs allow deposits very easily. You don't have to write a check. You can do a wire transfer, you can do direct deposit, and you can use credit cards for most of them. Make it very easy. Most allow the donor advisors to make grant recommendations online or by telephone. Make it easy. Minimums for starting a DAF can be as low as $5,000 or $10,000, and with additions, the additions can be even lower. You can throw in another $500 or even $100 anytime you want. There are also very low minimum requirements for the grants, and it can be as low as $100. So the DAF, once it's set up, can be very, very easy. So how can we use our DAF? Well, we can do it as an individual. An individual can use a DAF, can set it up very, very simply. It's an easy application to make. Let's go to the next slide, please. Any individual can do it. You can usually set it up in a day or two and be funded very, very easily. You can do it when you're getting close to the end of the year and you realize, uh-oh, I have more income than I thought I was going to have, and I don't have enough deductions, and I'd like to get some more deductions. I want to do that bunching of deductions because I don't have enough other deductions. So let's get it done, especially under the new income tax rules on itemized deductions. Maybe I'm going to get a big bonus this year that I didn't know, or I have a realization event, such as a golden parachute, or I sell my business I wasn't expecting to do. So an individual can set up a DAF. And don't forget, if I'm going to do it as an individual, I might want to remember to name my successor donor advisor. A family or a group can set it up. I might set it up where I'm the senior generation, and I'm going to set it up for my children and grandchildren. I'm going to use it to educate the generations on philanthropic philosophy and giving. I'm going to use it to teach my family about giving, and that's a wonderful way to do it. Or I might do it horizontally. I might set it up with my siblings, and might want to say, let's get together and pool our resources and do it as siblings, and that's a way to do it too. Or I might just do it as a group of friends, a giving circle with a common cause. A group of us all feel strongly about a particular cause, not necessarily a particular charity, but a cause. And we give to multiple charities that all pursue the same cause that we do. We might have a loved one that we've lost, and a bunch of us want to give in memory of that same person. So we get together and create a DAF and give in memory of that loved one. Or there's a bunch of us who have a particular charity or cause in mind, and by pooling our assets, we can make a larger impact in that area. So that would be another reason to consider using a DAF, an easy way to do it. This can even be used by an employer. An employer could set up a DAF and encourage employee giving, even allowing them to use payroll deduction and have the employees add to the DAF through their payroll deduction, and then have the employees designate the grantee organizations. And that's a nice way to help employees do that, because if we don't see the dollars, we're more likely to give it to charity. If once we get it in our pocket, we may not be so willing to give it. And then we heard from our advisors that the DAF was used effectively when we had an old private foundation that worked well in the past, but because of changing circumstances, it wasn't working as well. If we had an old foundation where the senior members have either died or are no longer active, and they're no longer taking the active role of managing it, and the next gen is saying, I don't want to do that. I don't want to spend my time managing it or spending the money to have somebody else manage it. It's expensive and time consuming. So let's convert this private foundation to a DAF. Let the DAF do all of that management. We'll pay the DAF fees, which are far less than the private foundation, transfer all the assets over to the DAF. The board of the foundation becomes the donor advisors of the DAF, and we've simplified our administration. That can happen. Alternatively, if we have a private foundation where there is now dispute among the family, senior member has died and we have the 3 siblings that don't get along, we can divide up that foundation. We have the 3 siblings, we divide the foundation into 3. Each one takes their third of the foundation over to a DAF, and they can simplify it and run, each one of them run it, but run it as a DAF, save the money and have it that way. They can each have their own donor advisors. Each child of the founder can have it with their own children and have them as their donor advisors. So it's very simple. A lot of the sponsors like JCF have advisors within them that can help the new donor advisors administer their DAF and get them set up and get them going on a way to properly do it so that it's a good successor to the old private foundation with the advantages of the DAF. So there are a lot of good ways to use a DAF and very effectively to get the goals of our clients in their charitable giving in a very effective way.